Hello, this is Kevin of the Traders and Investors Club. In this session, I'm going to discuss volatility and how we can use it to help us with our trading. The first thing to do is define volatility. My definition is the measurement of the amount by which the price of an asset fluctuates around its average value within a given period of time. Or another way of putting it is the speed of price change in the market. Now, why is an understanding of volatility important to us as traders? Well, it gives us the ability to calculate the probability of the asset being within a particular price range at a future date. First, we're going to take a look at Bollinger Bands, which is one of the most popular technical analysis indicators for calculating volatility. To plot Bollinger Bands, the first thing we do is to calculate a moving average on the price series. In this case, I've calculated a 20-day moving average, which is a popular setting for Bollinger Bands because it approximates a month of trading activity. The next thing we do is to plot a line 2 standard deviations above the moving average and another line 2 standard deviations below the moving average. This provides us with a set of trading bands or an envelope within which the price movement is largely contained. The Bollinger Bands are designed to contain 95% of the movement of the price. However, this doesn't always work out in practice, as we shall see in a moment. So, what is standard deviation from the mean? It's a mathematical formula that provides us with a widely accepted measure of volatility. It's used in all of the mainstream options pricing calculators. How do we calculate it? Well, the first thing we do is we have to plot the mean, which is another way of saying a moving average. In this case, I've plotted a 20-period moving average here on the price chart. Let's zoom in. The next thing we do is we measure the distance between all of the closes and the mean itself. Here are a couple of examples, but we do this, of course, for every price bar in the chart. As you can see, once we take the mean away from a price, we do very often have a negative value, such as in this case. In order to get rid of the negative values, what we do next, we square all of the values that we've derived. We then add them together, and we divide them by the number of periods that we used in our calculation, such as 20. We then take the square root of the result, and that gives us our standard deviation. One of the shortcomings of this technique is that stock prices are assumed to be normally distributed. Unfortunately, this is not always the case. When we graph a large sample of normally distributed data, we usually end up with the familiar bell curve shape. Once we have calculated the mean or average of our normally distributed data series, we can expect 68% of the sample to be contained within one standard deviation either side of the mean. Furthermore, we can expect 95% of our sample to be contained within 2 standard deviations. Does this sound familiar from our Bollinger Bands discussion? Let's look at an example of normally distributed data with a bell curve superimposed. This is a graph of a sample of blood pressure readings. As you can see, the bell curve is a very close fit. However, when we superimpose the bell curve on a series of stock price data, we see that the prices do not conform to our expectations. You can see that there are many taller peaks than we would expect, and also fatter tails, which indicates that statistically highly improbable events occur in the stock market more often than we would expect when using statistical techniques. Now, let's take a look at how we calculate volatility. Here is the Metastock formula to calculate monthly volatility. Although the formula may look complicated, don't worry about it too much. Most charting packages will have built-in volatility plots. However, I always like to have at least an appreciation for how the wiggly lines on my charts are calculated. So let me break the calculation down into bite-sized pieces for you. The first thing we do is divide the price by the previous price. Here is the metastock nomenclature for doing just that. The -1 refers to the day before. The next thing we want to do is calculate a natural logarithm of the price change. The reasons we express movement in terms of logarithms as opposed to percentages is because a 50% loss and a 50% gain are not necessarily the same thing. Think of a stock at 100. If it loses 50% and then gains 50%, the stock goes from 100 down to 50 and up to 75. Instead, a 50% loss and a 100% gain are the equal magnitude inverse of each other. If the stock goes down 50% and then up 100%, then the path is from 100 down to 50 and back up to 100. You get the same result if the path reverses, going up 100% first and then down 50%. The stock starts at 100, then up to 200, then back down to 100. Up and down percentage point moves are equally likely, even though up and down are not symmetrical. As we have discussed, a stock that loses 50% must gain 100% in order to get back where it started. Up and down movements measured using logarithms are symmetrical and so are far more suitable for the task at hand. The next thing we want to do is calculate the standard deviation over 23 periods, which is closer to a trading month. You may remember that we discussed standard deviation when talking about Bollinger Bands. In the case of Bollinger Bands, we were looking at calculating the standard deviation for price, and here we're looking at calculating the standard deviations for price change. The next thing we do is multiply the result of this calculation by the square root of time. In this case it's 365 days in a year, and multiply the whole thing by 100 in order to normalize it. Now that we've done all the groundwork in our study of volatility, let's get on to the exciting part, volatility in action. Okay, a quiz. These stocks are both round about the $60 mark, Costco and Teva Pharmaceuticals. Which of these stocks is the most volatile? Okay, let's apply our volatility measurements, in this case the yearly volatility measurement, and this is very similar to the formula that we examined to calculate monthly volatility, except that we replace the number of trading days in a month with the number of days in a year. Now what we see here is over a year that Costco is slightly more volatile than Teva Pharmaceuticals. Now let's do the same calculation but over the last month. And as you can see here, Costco is volatility is about 17 compared to the volatility of Teva coming up to around about 23, 24. So the important thing to realize here is volatility will change depending upon the period being examined, and when we're actually projecting into the future to try to calculate where we think prices might be, we have to take into account all of these factors. Time is very important when calculating volatility. Right, now here's another quiz. Same question, which of these stocks is the most volatile? But be careful, it's a bit of a trick question. I'll give you a clue. You see the price scaling on the right hand side here compared to the scaling here. Let's equalize the scales on both sides. Okay, that's better. Now which stock is most volatile? Well, it probably comes as no surprise to see that Scottish and Southern Energy is relatively low, under 25 yearly volatility, and Xstrata, the mining company, quite a volatile stock, volatility down in recent times, but still round about the 80 mark, which makes it 3 times more volatile than Scottish and Southern. Let's look at the same stocks but calculating monthly volatility, and as you can see, they're in monthly volatility terms they're still more or less about the same.